Yes, I will definitely go through ThinkOrSwim. Um, and yeah, for sure, we're gonna go through
I will
how
definitely
to
go
do
through ThinkOrSwim.
on YouTube or live. All right, cool. Let me sign in on Toss real quick. Please open in privacy. Cool. All right, we all good? All right. So you guys can see me. Let me start my recording here. All right, guys, welcome to the HaiKhuu options class. My name is Mike. I'll be hosting this for you guys. Let's get my slideshow presented here. So I'm sure a lot of you guys have attended at least one of these classes before. So if I'm sure you know then the basis of how I prefer to trade options, and that how now a lot of people in HaiKhuu are starting to trade options because of its nice success rate, is going to be selling cash secured puts. All right. So it's just a disclaimer. None of this is actual financial advice, yada, yada, yada. It's all just for educational purposes. Of course, that's what we're all about here. All right. So first of all, if you don't know, what is a cash secured put? So selling a put is essentially placing a limit order to buy 100 shares of stock at the strike price that you pick. So essentially, someone is literally paying you to put an order to buy 100 shares of a stock. All right. So if the stock stays above your strike price, by the time it expires, you're going to keep all that person's money. If it falls below your strike price by the time it expires, then you're going to be forced to buy the 100 shares and you're going to keep that person's money, aka the put buyer's money. Okay. So best way to do this or to understand it is probably just go over an example. I always use AMD. It's such a great stock to sell puts on. So in this example, let's just say AMD is trading at $80 a share. And so you decide to sell a $7 put that expires in, like, let's just say a month, and you collect 50 cents a share or $50. Okay. So two things can happen. Again, AMD stays above your strike price of 70 and by the expiration time, and then it expires worthless. And what does that mean? That means the $50 that the person paid for the put, it all goes to you. You keep the $50. You don't buy the shares. But if AMD drops below $70, then you're going to be forced to buy those shares, 100 of them, at $70 a share. But you keep the $50 as income, so your cost basis technically would be $69.50 per share. Okay, so that's what it is basically. And so when you want to sell a CSP, so for one, I think the most important thing here is the stock selection. You don't want to pick a stock that you don't want to own forever, because it's a stock market. This involves risks. Sometimes stocks can go down and not come up for a while. So you want to be okay with holding the stock literally like forever, and also it has to have liquid options too. The best way to find or to see if the stock is liquid or not, we'll go into the broker platform ThinkOrSwim later and see this, but it's the bid-ask spread. You can use open interest and volume too. Anyways, the most optimal time to sell a put on a stock is when the stock is pulling back and it's trading at the lower end of its trading range, So we've seen AMD trade from, I think it dropped all the way down to like $70 recently, and it's traded as high as like 90. So, I mean, yeah, you can sell puts when AMD is trading at $90 a share. You can sell like, $75 puts, you get a little bit, but you're going to collect way more premium, and you'll be able to go farther out the money if you're selling puts when AMD is trading at $70 a share, right? Because if it's trading at 70 a share, then that means that like the $65 puts, they're going to have a ton more premium in them, and it's going to be a way lower price that you're going to end up buying the shares at one point. So basically, I recommend picking maybe just like one or two blue chip stocks to trade. If you have the capital, doing this on the SPY is probably the safest, because that's literally just, a broad ETF, S&P 500. So worst case, it'll be long the S&P 500. That's like what 90% of investors buy anyway in their 401ks and whatnot. So yeah, and also implied volatility is going to affect the prices of options a lot too. So generally, you should sell put options when the VIX, which is the volatility index of the S&P 500, is green, which means volatility is up for the day. And then also when the stock is down for the day. So when the stock goes down, we know the prices of puts goes up. And so that's when you want to take advantage of selling them, okay? And next is expiration dates. So this part is pretty subjective, people like Carlos likes to do the weeklies, and I think like Lion and HaiKhuu likes to do the weeklies also, which is whether you do weeklies or monthlies, it's really up to you. But the most important thing is that you're finding the most optimal credit for the risk that you're taking. Okay, so you don't want to collect like $5 for selling a $70 put on AMD that expires in a week. You don't want to tie up $7,000 to make $5 in 1 week. And that's the thing, between the difference between weeklies and monthlies is the monthlies will have more premium for the same strike prices. But at the same time, there's going to be a longer time till expiration. So you're going to have to wait longer to collect the premium. All right. So like I said, it's pretty subjective. There's no right or wrong expiration to pick. The most important thing is that you're getting compensated well enough for the amount of capital you're tying up for how long you're tying it up for. All right. I prefer 21 to 45 days, sometimes lower. The reason for this is because let's say, again, AMD's trading at 80. If you go 45 days out to sell a $70 put, you might get $100, all right? But if you go 1 week out and AMD is trading at 80, the $70 put might be worth like $5, so you can't sell that. So you'd have to sell maybe like a $75 put, maybe collect like $80. So you're going to collect the $80 in a week, yeah, but worst case, you're going to get assigned at 75. And the strike price is super important because remember, you want to think of this stuff as like the worst case, you getting assigned, right? So think about it. If you pick a 75 strike, you can get assigned versus a $70 strike. You're going to save yourself $500 theoretically if you pick the $70 strike over that, because the difference between 70 and 75 is $5, obviously, times 100, $500. So there's that. Benefits of this stuff. I'll answer that question in 1 second. He asked, can you explain what you mean by getting assigned? Real quick, let me just go over this slide. So benefits of CSPs, it allows you the ability to collect premiums as passive income, obviously. You can acquire shares of stock at a lower price at a discount, and you don't really need much time at all to do this. Like you can just open your account. You see AMD's trading super low at $70. You sell a $60 put, and you're done trading for the day. And when I say getting assigned, when you get assigned, so this is where like understanding exactly how options work is really crucial. So let's say, so getting assigned just means that you're selling a put, you're being forced to buy 100 shares at the strike price. That's what getting assigned means. You're getting assigned the shares, the 100 shares at your strike price. Okay. So the put seller or the put buyer, remember when you buy a put, you're agreeing to sell your shares. When you sell a put to someone, you're agreeing for them to sell the shares to you. So if he exercises his right, it'll assign you his 100 shares that he's selling. Okay, so that's what getting assigned means. Downsides of CSPs, so it can tie up a large amount of equity, especially depending on which stock you're picking. It is slow and passive, but it does work, and it's not extremely profitable for the cash tied up. And that's why my main strategy is spreads, because when you define your risk, you use less capital. You don't have to So when you sell a cash secured put, you need 100 times the strike price. So for an AMD 70 put to sell, you're going to need $7,000, right? 100 times 70. If you sell a put credit spread, you sell the 70 put, you buy the 65, you're only going to need $500. And Glency is asking a question. He says, how do you use earnings as an advantage to CSPs? So the thing about earnings and cash secured puts, well, just options in general and earnings. So before earnings and like 1 month before earnings, the implied volatility of the stock will be increasing, right? And as the implied volatility increases, the prices of all options increase, puts and calls, right? So and also right after earnings are announced, all that implied volatility, it gets crushed. It drops a lot. So that means also the prices of options drops a lot. So to use CSP as an advantage with earnings, or just even selling call spreads or any short option strategy, is to sell puts pretty much right before the earnings are announced, and then you close it out pretty much the day of the day after earnings announcement, and that way you sell at peak volatility, and then the earnings gets announced and the volatility gets crushed and all the options prices get crushed with it. So this does work, but if the stock drops a lot, then obviously you still have that assignment risk. But most of the time, usually you should be good. But obviously you have to expect the worst case scenario on that, especially with earnings. It can be a lot of movement, but for the most part, it's a really good strategy to sell CSPs before earnings, again, as long as it's a good stock and you don't mind holding it. So now I'll talk again about handling bad trades. So let's say with our AMD example, you sold a $70 put and now it fell to $65 a share. Okay. So anyway, so the first thing you can do to handle a bad trade is to roll. So what does it mean to roll? When you roll an option contract, you're buying it back and then selling a new one at most of the time at a later date. Okay. And then, so here's the thing, whenever you roll, let's say you usually you'll roll to a farther expiration date at the same strike. If you can, you want to lower your strike so like you can roll it from like a $70 put to a $65 put. That's ideal, but sometimes you have to pay to do that, and you never want to pay to roll your puts. We're going to go into this. It's a lot easier to explain when we go into the actual TD Ameritrade platform. And then also, accepting assignment. So if you're cash secured, obviously you can just take the assignment of the 100 shares and then hold them. And if you want, you can sell calls against them too, covered calls. Okay, so now I kind of just want to get into the broker platform here. But just a quick conclusion. It's a great way to make passive income. You want to trade CSPs on stocks when they're trading at the lower end of its range, when implied volatility is high, ideally. And this strategy you can do if you work a lot. The strategy is great for you. You can manage this with literally like 10 to 15 minutes a day easily. Okay, so let's open ThinkOrSwim here. So I don't have any cash secured puts on right now. Actually, I mainly trade these SPX broken wing butterflies, which is still the core of the strategy is selling puts. But just because we're talking about that, let's just go to AMD right now and see what's good with AMD here. So AMD's trading at $81. You go to the trade tab, you see the options. So this is the first thing you see when you pull up the options chain. You click the trade tab up there. So you get all these expiration dates. And again, I was saying I like 21 to 45 days. The number in the parentheses is how long you have till expiration. So let's maybe start with the weeklies. So AMD's at 81. I kept saying, sell 70 puts. Anything you want to sell out the money puts, which means the put is below the current stock price. So anything under 81, would be considered out the money. As you can see, it has a black background. These in the money ones have the purple background right there. So, these contracts expire at the 19th of March in 5 days. So they're not going to have a lot of premium, with only 5 days to go. Let's just look at the 75 put. You get $30 right here if you sell a $75 put that expires on the 19th of March. Okay. If we close this and let's go to 33 days out, the 16th of April, the $75 put here, look how much premium it has. It has $182 in premium. So this is the difference. The reason why it's like that is because any puts with a further out expiration date have more extrinsic value, aka time value. So the more time an option has, the more it's going to be worth, because how options are priced is by extrinsic value and intrinsic value. And we're capitalizing on time passing and collecting extrinsic value mainly when we're selling these puts. So a couple different strategies you can go about here, obviously, right? So you can sell the $75 put. You don't get much. I mean, if you're selling weeklies, you maybe want to go collect at least like $50, $55 there. So you can do that. You can collect it next Friday, I think. Collect $55 for tying up 7,700. That's cool. That's fine to do. Like I said, my preference is to go a little bit farther out, 33, 45 days out or whatever. And the reason I like this is because, one, you can go, the main reason that I like it is because you can go further out the money. So to collect the same amount of premium, like $50, I can sell like a 67.5 put. Yeah, I still have plenty of time to go, but also the benefit of going further out in time is the theta decay actually is still really nice. And also you can go and further out the money puts, they decay quicker than puts that are closer to the stock price. So it's kind of like a double-edged sword if you haven't noticed. Like this one, the theta is really good because there's only 5 days up. And, if it stays above 77, there's only 5 days left to go. So the theta is going to hit it really hard. But at the same time, for these ones, the further out the money ones with longer time, the 67.5 put is going to decay way faster than a 77 put just because it's so much farther out the money, So my preference is to look at the worst case scenario, and that is that you get assigned, right? And I see this 67.5 put, I get it signed at 67.5, obviously. But the 77, you're going to get assigned at $77. That is literally $1,000 difference, right? If you get assigned. And if the market crashes, like you're going to get assigned. So that's why I prefer to go further out the money and sell those, because one, it decays a lot harder than ones that are closer to the stock price. And two, they're actually like less volatile too. These weeklies, like they can shoot up and down really quick because of the gamma, since like it's so close to expiration. It doesn't know if it's going to expire in the money or out the money. So it's really volatile, right? But these ones, you still have like a whole month. So people aren't really freaking out about getting assigned about these just yet. And so they'll really slowly decay to your benefit. So Elliot is asking if I can go over the Greeks. So the only Greeks, I mean, you should understand all the Greeks, but you don't honestly have to. The main Greek that you should know and that you should look at is delta. And I have that right here. You can customize that in the ThinkOrSwim. You can customize these. You go to options in Greeks, delta. So the delta, there's two definitions to it. The first one is the percent chance that the specific contract will expire in the money. Okay. In the money. That means you get assigned. The percent chance that you'll get assigned on expiration date. Well, it's not the percent chance that you get assigned, because it doesn't take into account early assignment risk if someone were to exercise it. But the delta is the percent chance that the option on the expiration day is in the money. So the 67.5 put is 0.09. Okay, so there's a 9% chance that on 16th of April, this expiration date, that AMD will be trading at lower than 67.5. 9% chance. If you go to 19th of March, there's about an 8%, just to compare the equalness of the deltas, that the 0.08 delta, which is the closest here, is the 74 strike. Okay, so there's basically an 8% chance that AMD will be trading at or below 74 on the 19th of March. Okay, so that's the most important one, in my opinion, to look at is delta, because it gives you your probabilities of success. And also the second definition of it, it's the amount that it's the amount that the contract moves for each $1 move up in the stock. So that's why puts have negative delta, because when stock prices move up, the put options go down. Specifically for the $74 put, it's negative 0.08. So if AMD goes from 81.05 right now to 82.05, theoretically this contract should decrease by 8 cents from its 21-cent premium currently. Okay, so that's the delta right there. There's also theta. I don't even have it up here. I can put it on. Theta, I mean, for one, all these Greeks, they're pretty subjective, because one, they're constantly changing. Like you can sell a put with a 10 delta today and it becomes a 30 delta tomorrow. So, they're constantly changing. That's why I don't, like to fully rely on them for anything. I do and I don't. Like I use them for reference, but you don't want to rely on something like that that's constantly changing. But you do want to take into account, So what are good, better, and best ranges for delta? So here's the thing. When you're selling cash secured puts, the lower the delta, or the further out the money you go, that's your safest bet, essentially, since you're agreeing to get the shares at a lower price. But, anywhere from negative 0.10 to negative 0.30 delta are considered, what most people like to sell them at. Let me put the delta back here. So, like I said, I wouldn't sell put. You can. I don't personally sell any puts that have a delta of higher than negative 0.30. So, anything in like 34, 43, anything above that, I don't sell, because I want to have at least a 70% chance of probability of winning my trade. But also, I don't like to sell things too low of a delta. However, I do like to stay on the conservative side. I'm usually more closer to the 10 deltas, the 13, 12s, around that range, just because I'm more conservative. But yeah, so it's just kind of based on what you want to do. There's no best delta to say per se to sell. There's been lots of back tests done, and it really just depends on the current market situation, which one's going to end up being the quote best delta, which you can't predict. So that's why I like to focus on the strike price and the amount of premium you're getting for the amount of risk you're taking on, as opposed to just the delta. But definitely, I would recommend selling puts with a delta of negative 10 to negative 30 delta. Okay, so that's about a 90% chance to about a 70% chance of those expiring in the money and you making your money. Okay, so now that we've kind of gone over that, I want to go over spreads a little bit again, because I think a lot of people would benefit from that. If you have a smaller account, then you definitely benefit from spreads. So basically, let's just use the $75 put here as an example. So you want to think of so we're talking about put credit spreads here. And a put credit spread is pretty much a cash secured put with a hedge that you buy along with it. And it's usually done in the same order, but if you have a cash secured put already open, then you can convert it into a put credit spread by simply buying another put option below the strike price of the one that you already sold. So normally, if you just wanted to start by opening a vertical put credit spread, it's called a bull put credit spread, whatever, or bull spread, whatever you want to call it. You'd start by selling a cash. It's basically you sell a cash secured put. That's one part of the order. And then the second part of the order is buying a put. Okay. And you can buy any put below the strike price that you're selling. And that would be considered a cash secured put. As you can see, you want to collect credit. If you do it the other way around, that's a put debit spread, which I'm not a huge fan of because the theta decay isn't as good. So remember, you sell a put and then buy one anywhere under it, and that's how you're going to create a put credit spread. So what's the benefit of this? The benefit of this is that one, you only need $500 to sell this put credit spread, as opposed to $7,500 to sell the cash secured put on AMD at 75. Okay, so that's one. You literally take your buying power and reduce it by a lot. But on the downside, you're spending $86 of your premium, because look at, you collect $182 for selling that, and then you're basically you're giving up like 86 of that or so, and instead of collecting like the 182, you're going to collect $101. So you're technically quote wasting some money, but it's for protection and it's to reduce your capital requirements. So basically, what does this mean? So now when you have a put credit spread on, you have to think of them as two separate contracts, like, because I'm sure all you guys have bought options before. You've bought a put. Your max loss when you buy a put is just how much you spent on the premium. In this case, about $86. So this put credit spread stuff sounds really confusing, but it's really not. So you sell this, and then you're financing. You're basically financing a long put with the put that you're selling, and for hedge protection. Because let's say you have a small account and you can't afford to accept 100 shares of AMD, right? So worst case now, if this if AMD drops to 65 when you have this put credit spread on, you will have to buy it at 75 a share, 100 shares. But now you have the option to then sell your shares at $70 a share, right? So you effectively are buying at 75, and then you can immediately sell for $70 per share. So that would be a $500 loss. But I mean, even if AMD goes to 50, your loss is going to be the same. That's why they call it defined risk. So if we go to analyze trade here and look at the trade tab, we can see. So this teal line over here, that's the expiration line. So this is what the spread will be worth at expiration. And the left here, so you see it's plus 100. So if anywhere above this break-even price right here, it's around like 74, 75, anywhere above like the 75 range, no matter how high it goes, you're going to make $101 if it expires. But now over here, your max loss, if you can see the number at the bottom left right there, the minus 399. So your max loss, even like no matter where AMD goes, like you can see we're all the way down at 59 here. Your max loss is still going to be 399, and that's because you have the $70 long put, and you can see this little line ends at 70 right here. That's your long put, because worst case you can exercise and sell your shares for 70, and so it doesn't matter how low it goes. You always have that hedge protection. Okay, and so that's the put credit spread. So you can see it actually, your max loss is only $399, not $500, because you're still keeping the premium, which is $101. If we go back and just analyze the $75 put without the spread, you can see this line right here, this expiration line, just continues to go lower and lower and lower and lower and lower. This is equal to owning 100 shares at 75. Okay, so if it goes to 46, you're still going to be on the hook for shares. With the spread, you'll at least be able to sell at $7 per share. Honestly, it's not likely to happen. Usually market doesn't crash that much very often. But when it does, especially if you have like a smaller account, can be better. Okay. So that is put credit spreads. And now I'm going to show you guys my SPX positions and why I prefer them better to put credit spreads. So my SPX positions are actually, they're called put broken wing butterflies, which is basically a put credit spread with 2 more contracts. Okay, so let's go to SPX here. So we'll start. I place this trade. I have a lot of trades on the SPX. It's mainly what I trade. But my oldest broken wing butterfly is on the 1st of April, right? So these are the contracts that I'm currently short. So I sold. If we were to do this in a credit spread, basically, I would have sold the 3660s and then bought the 3650s. Okay, and that's a put credit spread. Let me show you how this looks on the risk diagram. So this is a put credit spread on the SPX, just like AMD, except it's on the SPX. Okay, I sold the 3660 puts, which is, if you don't really know SPX, it's 10 times SPY. So basically I'm betting on SPY or the SPX staying above 366. Okay, so anywhere up here, I collect all the credit of $55. And down here, this is a 10 wide spread. So my collateral requirement would be $1,000. And so my max loss is closer to 1,000 over there. And this is a good trade. It's, it's really high probability. You can see this is this gray area. This is the expected move for when this expires. So like my probability of success is way to the left. Like it's not predicting that the stock will fall any lower than that. The only thing about this is that, see this purple line? This is your T+0 line, and that's how the trade is looking today. Okay, so as we go on in time, this purple line should get like higher and higher because theta is working for you, right? And this, see, you get more profitable as time goes on. You want this purple line to move up and to the left because, whoops, that's credit, not the date. I'm basically simulating going farther in time right now to, further in time. So right now the platform thinks we're on 4/1, April 1st. So as you go, that purple line will benefit you because of theta. It's even better with a put broken wing butterfly. You see, this is my trade here. So see the purple line? Now look at this purple line, the break even goes all the way actually past 3660. So even if the stock drops below the put I sold with this broken wing butterfly, it's still projected to be profitable here. And that's just because of this little tent here. You have extra hedges in place. So let me show you how to actually get into one of these. So I always use 45 days for these guys. I'm just going to use 7th of May since I already have one on that 45-day expiration. Don't want to get it confused. And so when I place these trades, I always look for the 20 to 30 delta as usual. I don't mind going up higher in delta with this one because it has more hedge protection to it, right? So let's just say, and I look for the one with the most open interest because you don't want to sell puts with like no buyers. I mean, SPX, you can pretty much sell any of them, but I like to use the even numbers. I've been selling these 3,700 puts for a while. So basically what you would do is this is your base trade, is that you're selling a $3,700 put on the SPX. And think of this like a cash secured put. As long as the SPX expires and the price is at least 3,700 or higher, you're going to collect all that money. In this case, it's like $5,000, right? Yeah, $5,000. And then after that, I go 50 strikes down to make it a put credit spread, basically. So it's to the 3650. So now that's 50 points wide. So you'd need, like $5,000 for that. Let's look at this. Yeah, $5,000, and you got your basic put credit spread set up there. But to make it even better, because this 3650 put, you're just gonna lose money on it most of the time, because you theoretically want your your hedges to expire worthless, because that means the put you sold is going to be expiring worthless, right? For the most part. But if you want a hedge that's like even better, you can go up. I go up 40 points above my strike that I sold the 3700s, and I go ahead and buy the 3740. All right. So now I have two put hedges. I bought a 3740. I bought a 3650. So I'm long two of those puts, and I'm short the 3700s. Now that's great, but now I'm paying a debit. You don't want to pay a debit, right? So to complete the broken wing butterfly, you sell another 3700. It's still green, but you can see it's a negative 60 credit. All right, so you collect $60 for you literally. So I sold two 3700 puts. I bought one 3650 and I bought one 3740. And so now let's take a look at the risk diagram for this guy. See, so now it's just not like some straight line and then it goes down. Now you have, look at this, you have this expiration line right here. So you could theoretically in this trade make around $4,000 if it happens to expire right at your short strikes at $3,700. The reason why is because, again, let me go here. You're short the 3700s. If it expires right at at 3710, let's say, then that means your 3700 will expire worthless, but your 3740 is going to expire with money still left in it that you're going to keep, right? So not only are you making money on the put you sold, but with a broken wing butterfly, you can also make money on the put that you bought that's in front of the 3700, right? So that's why in between these two right here, the 3740 and 3700, that's this little profit area right here. And I don't shoot for like $4,000 profits, but as you can see, if we go, I'm going to change the date from like what is this? Oh, we're on 3/24 already. The expiration date for this one is in May. So let's just go all the way to like April. So this purple line is going to keep moving back and back. Let me show you like this little profit hump that starts to form. See that how that line keeps like moving up and up and up. Look at that. So that's literally your profit and loss. So you see, it actually benefits you if the stock comes down a little bit with this strategy, right? With the put credit spread, you never want the stock to go down really with the put credit spread because it's gonna hinder you. But with a put broken wing butterfly, if the stock starts coming down, you actually start making more money given it's towards the end of the expiration time. So it does take time for this profit hump to form, but it's so much better than the put credit spread. It just takes more contracts because look at it here. If like you open this trade and your stop loss would be here at the end of the left side of the tent. So we can do that. So your stop loss there. So even if the stock, you open this trade right now, like let's say the market's open, this P&L open right here, this is for the left one, you'd only lose like $150. And this is like $1,000 max loss spread. So worst case right now, your stop loss would be, you would lose $150. And yes, you can collect the profit before expiration on the broken wing butterfly. I actually always do that. I usually take it at $60 profit, right? So this one is actually worth 60. So basically, once this credit goes to zero, then you can take profit. Yes. So you want to take profit early. You don't have to let these expire, but you can if you want to avoid the commissions. Okay. But again, just look at this, the profit hump right here. You keep going in time and time. This is a theta working for you, And then look at now your break even over here is past the tens. So like in some cases, if like the stock market crashes and you're already like 3 weeks into this trade and it falls below here, you could still make money, So that's just a beautiful reason why I love the broken wing butterfly. I'll show you all my current trades right now. So I have this 1st of April. Why it's not popping up? 1 sec. That's weird. It's not popping up. ThinkOrSwim, the Analyze tab can be kind of buggy sometimes. It's a downside to it. But it is very important to understand this stuff 100%. And well,
check your date.
It's not going to show me any of my trades here. but you can see I have 10 right now. And so let's just look at this one. So when I open this broken wing butterfly, it's actually the same exact structure. We're just looking at selling 3,700 puts, buy 3650 and the 3740. I sold it I got $40 credit. You'd see at the trade price. And right now, so put credit spreads can only go to zero, but broken wing butterflies, since you have that put ahead, you can actually get paid a credit just to take the trade off. So look, now I sold for $40 and I can actually collect more credit for closing this trade out. So 15 cents more, which would be a $55 profit since I sold at 40. And now it's going to pay me $15 to take it off. So that's 55. And that's how this trade kind of works. Like, when that profit hump goes up, this thing can go up and up and up and up. So also, I'm going to open Tastyworks here and we'll go through how put credit spreads look at closer times to expiration versus these broken wing butterflies. And I like Tastyworks for forming these trades because it actually is a lot easier than ThinkOrSwim, just the way it works. Let me open this. So now we're on Tastyworks. This is very similar to ThinkOrSwim. The same guy made it. This is actually more updated technically, but let's look at how this trade works. So let's say you start at 47 days, you go to 3,700 or whatever. You form this trade, you sell the 3,700, buy 40 points up, go down 50 points, buy that, sell 2 of these, collect that credit. So look at it's at 25 credit right now. If I just click minus time, this is going to move this structure to a lower expiration date. So click minus time once, you're up $10 now. Now you're up 15, whatever. Keep going down here. So now you're at 10 debit, right? So that means you're getting that credit to take it off. Okay, so you started at like 25. Now you're at $35 profit since it's at 10 debit. And basically just keep going lower and lower. And the debit should continue to increase. So that will not happen. So let's look at how if this structure was tested and the worst case scenario happens, and let's say you happen to be short for some reason you sold the 4,000 puts. Look how nicely this structure holds up even when it's so far in the money. Like look at it, it's still 15 debit. If you go up in time right now, this should be a credit. So if you go to the 47 days out, if you were to sell this is literally all in the money right now. You're selling 4,000 puts. The SPYs even hit 4,000 ever. So it's only worth 55 credit now. And if you keep going down in time, this will keep getting, look at that. It's already two clicks and you're down to 0. You probably hit your profit target already. But farther you go, look at it. It's 50 debit, 80 debit, 105 debit. So literally, it actually benefits you if the stock pulls back because look at you keep making more money as time goes on. With a put credit spread, if a put credit spread was in the money like this going into expiration, it's going to be the opposite. Look at now you're up $180 to take it off. So let me show you the difference between that and like a put credit spread. So we start at 47 days. Let's sell an in the money put credit spread like 10 wide. Let's just do, it would be similar to like 39.70 and 39.60. So this is worth $440 credit. If you keep going in time here, it gets higher, higher, higher. It's not getting better, it's getting worse. You're losing more money as time goes on when this structure is getting tested, when it's in the money. The broken wing butterfly is doing better. You're actually getting paid more money as time goes on. You see? So that's why it's so much better than a put credit spread because it's the hedge protection and the structure itself is just so much better because you have, the extra put ahead here to kind of hedge your losses. So that is why I personally prefer selling put broken wing butterflies on the SPX over selling just cash secured puts. Like, other thing you can do is just sell CSPs on the SPY, but I think I did this last time. When you sell CSPs, you're kind of relying on the market to continually go up, right? Or at least not go down. So let me show you. Actually, we can go on demand here. We can go back in time. Let's go to 2009. No, it doesn't. Damn. All right, well, we'll have to use 2020. The 2020 correction, I'm sure you guys are all aware of. So I think we did this last time too. I just kind of want to show you like worst case scenarios, because selling cash secured puts sounds, amazing, especially in bull markets, but it's not always a walk in the park, especially in really, really, like, this market isn't bad yet. This is actually right before the crash. We can just kind of go in. You see where the SPY is right now. It's pretty much coming off its all-time highs. This is February 18th of 2020. So we can go in and sell a cash secured, like, if you wanted to, you just sell puts on the SPY, right? So let's just say you went ahead and you went to the 14 delta, sold the 310 put. Cool. Now you're short a 310 put. All right. So now you want the SPY to stay above 310. And your only other option here is to roll it out and hope it goes up higher or accept assignment, right? So when the SPY drops, 40% in 3 weeks, your cash secured put's not going to be holding up very well. Let's see how it looks. So now I just went forward in time now to March 4th. See, the market from that time dropped, actually only down 9% at the moment, but you can see you're down $1,000. So this is what it looks like when a put is getting tested. Let's go to the expiration and see. So now it's just slightly in the money right here. You sold the 310, SPY's at 307. So how would you manage this, right? So the first thing you can do, is roll. So how do you do that? You buy it back, and then you still have 44 days out. In this case, it's almost too early to roll. So this is where selling puts kind of gets sticky, right? Because you don't really want to roll you can roll the 72 days. I'll show you that you can and still make money. So if you roll to 72 days out and you sell the same strike put, you're always going to collect money for rolling to the same strike in a further date, because there's always going to be more time value with further dated options. There's always more time value. So worst case, you can just keep rolling this literally until you get early assigned, or pretty much just till you get assigned. You can try to roll it down and out, which means you buy it back and then you go out again to the further date. And then you can try to roll it to a lower strike. Looks like here you might actually be able to do this to 306. Yeah, so you can still roll it out. You can roll it down, save yourself $400 and roll it down to 306. So let's just say we happen to do that. ThinkOrSwim doesn't really track it very well, but that's one of the things you can do. But then, we keep going. All right, I rolled it, save $400, yada yada. Now let's see what happens. Oh, the market is crapping itself again. Okay, so let's see what happens now. So let's let it for a load. So now you're down $2,600, probably even more if you didn't roll it. But now let's see our trade. 60 days out, and look how far in the money. We're far in the money now. Our delta is -1. So that means we basically own 100 shares at $306. We're short the put, but this put is literally anything with a delta of 1. It's acting like exactly 100 shares. So even if you're just at a 260, this thing went down at 240. So at this point, when you're doing CSPs, what are you going to do? You're going to wait. You don't have any, you're going to sell calls probably. Well, let's see. You got assigned at 310, 306. So if you wanted to wait, let's go ahead a little bit of time. Obviously, we know market had a speedy recovery. So you're obviously going to be fine if you just accept assignment and held, which is what you should probably do. But let's see. And luckily, since SPY is so liquid, we can still sell covered calls, above our basis. So if SPY crashed so much, you don't want to sell any of these calls. Like if you got assigned at like 350, 353, 354, you would have no choice. Like you couldn't even sell covered calls. You could for like 9 cents, but at that point, it's not even really worth it. You might as well just hold your shares, right? So why I'm going over this is because with a broken wing butterfly, instead of just like, holding and waiting for the thing to recover, my stop loss would basically be hit at some point during that. Remember, the stop loss for my SPX trading is at the edge of the tent. And I don't know why. It's not showing me my trades. My ThinkOrSwim is freezing. Yeah, thank you. Here's my date. Thank you. Here we go. So actually, I have some hedge puts. So in addition, let's talk about this too, black swan hedging, all right? So I have this other, so these are all my broken wing butterflies and SPX. They're doing great. But then also I buy, in addition to buying two, making it a spread and buying puts that way, I'm buying these really, really far out the money hedge puts right here, right? So basically what I do, if I think I need to, if I have like a lot of broken wing butterflies open, I'll go down here and I'll buy a super cheap SPX put option contract, like worth like around $100 or so. And this is just additional flash crash protection. This trade is going to lose you money most of the time, but when things like March 2020 happens, it's going to save your account value a little bit, because the price of these hedge puts would go. I've seen them go up to like $300-400, $500. When the VIX went up to like, I think it went up to like $80 or 80 in like March. Like these puts went up a lot. So it's kind of iffy. I like buying these puts, but I also don't because I'm losing money on them most of the time. Obviously, right now in the bull market, you can see. I haven't bought some in a while. These ones I'm just letting expire worthless. That's why it says I'm down 285. I've made a lot more than that selling these, opening and closing these broken wing butterflies, but still, I would be up a couple $100 more if I didn't buy these. But at the same time, it gives you a little bit of peace of mind in case the market were to tank a crazy amount, right? So let's, these are my SPX positions that we can actually see now. So look at this. So this one looks different, right? So this is another strategy that I use. It's basically just scaling into these butterflies on different dates. I usually open like maybe three broken wing butterfly, 2-3 broken wing butterflies a week on multiple different expiration dates. And in this particular case, for what date is this? This is for 9th of April. I have I have 2 different broken wing butterflies opened in the same expiration date. Look at all these contracts. So one of them is the 3700s, 3650. It's these 3. And then it looks like, I don't remember the exact sequence I got into these, but then I sold these guys, which were even lower. And most likely what happened is I sold this, and then the SPX sold off a decent bit. And so I was able to get some premium for selling further out of the money. I sold the 3630, 3670, and 3580 broken wing butterfly right there, right? So I was able to actually put 2 in one expiration date and actually extend my break-even point from, it was probably around like right here at first, and then I moved it all the way back to there. So that's another thing you can do. Place like one, market comes down a percent the next day, VIX goes up. You can, if you need to, just use the same expiration date and sell another broken wing butterfly further out the money. Just make sure none of the strikes mix with each other. You don't want to use the same strikes for 2 broken wing butterflies to avoid wash sales and just a bunch of confusion that's completely unnecessary. So there's one of them for that. You can see, and let's look at the stop losses set I have for them. This one's a little easier to see since it's not two. So if you click right here, you go set slices, you set it to break even, and then you click on the teal numbers for the expiration. It'll set these lines basically to your break even point. And so this line, this break even point at the end of the tent, happens to be my stop loss. So if SPX were to fall below this line, basically that's where I would close the trade out for a loss. And in this particular expiration, what expiration is this? For 16th of April, I have $3,000 worth at like 28.60. So that's 3 broken wing butterflies. And if you look at the P&L open down here, my stop loss, if it hit today, which obviously the market's way up here, I would lose $325 if the market tanked and went under 36.08. And so that I know how much I would be losing. Currently, where the market's at, it's up 110. And you see if you keep clicking up, going further in time, basically this is what it's doing. That 350 or whatever, now it's down at 228. And the profit's going up at the same time. So your max loss is decreasing while your current profit is increasing. This is beautiful. You see this amazing profit hump forming. So you're risk free to the upside. You're going to at least let this thing expire worthless for like $140. But if some time goes on, the market starts selling off. Look at that. You can make 500 here. You know, further the time goes, the more you're going to make. See, this profit hump just keeps getting better. Now you're in the thousands. And now look, even if your quote stop loss hits, you're not even losing money. You're actually making more money than you are right now. Your stop loss price you're actually up $800 this far into the trade. So the only way this trade loses essentially is if you open a broken wing butterfly and then the market crashes within like the same, like within like 1 or 2 weeks, and it goes way past your date there, or your stop loss, right? But I mean, if you're in this trade for like 2-3 weeks, like I have in my 1st of April expiration, look at my profit hump is already, this is like a real live trade. You set my slices again, plus that for the current price. Now, like I'm only risking $82 with this. Like if it crashes all the way down to 36.50, and my profit's still yet increasing every day, and eventually it's going to get to the point where you see now that the profit hump is outside of the tent. You can even make money if it crosses your stop loss. So, and this would never happen on put credit spread. When you're like for the break even point, like you would never make money past that. Let me show what I mean. Let's go just like this expiration date and sell 10 wide or something. I think it was, what date was that? This one. So this is my put credit spread. Let's look at the profit hump here. See, look at this. This is terrible T+0 line just going down, 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 as opposed to the other one, which is really flat with my broken wing. We're actually at 324 already. It's even worse. But yeah, you can see this. It does get better like up here from where you place the trade. But you know, if the market comes down here, you're going to be losing money. Like even my expiration date is 16th of April. Let's go like to the same week of that. Maybe 12th of April. Look at normally with the broken wing butterfly, you'd be profitable like to here. Now in this trade, you're barely even profitable. You can't even be profitable to your break-even price. So that's why put credit spreads are cool, but the broken wings, the structure is just 10 times better, way safer to do. And you have a lot more protection here. Let's see, how large of an account do you need? I would recommend, one, you need a margin account. So at least minimum 2,000 just to open that. And then I would probably, for every one broken wing butterfly, let's see. So I actually do this by percentage wise of your account. So let's say you have like a $4,000 account. I don't like to allocate any more than 50% at a time. Safest would probably be 30 to 40. So if you want to be really safe, multiply it by 0.3. You can allocate 1,200 with a four. Remember, each broken wing butterfly is $1,000. So, in other words, I would recommend at least $3,000 to $4,000 to per one broken wing butterfly that you sell. Obviously, you can allocate your whole account if you want, but it's a little bit more risky that way. But I think this is the safest and best way to sell option premium. Yes, it's not as like people say CSPs aren't, super sexy. This way is like the less sexy version of a CSP, so it's really not sexy at all. But it works well, it's consistent, and the best thing is that it does not require anything of the market. It doesn't require the market to go up, it doesn't require the market to go down. It literally doesn't matter. Like, it can pretty much handle any market situation. Like, I remember the day I showed Alan this, he opened a broken wing butterfly and the SPX was down like 1% or 2%. The VIX was up high. I mean, his broken wing butterfly was down like $30 or something like that, with CSPs and naked options in general. It's not naked if it's cash secured, but without any hedge puts to protect you, those naked options, when the VIX shoots up, are going to show much larger unrealized losses than any defined risk spread, especially broken wing butterflies like this one here. And depending on how you scale this, you can shoot for anywhere from like 1 to 5% a month. In addition to these broken wing butterflies, I think I have like 40 to 50% of my account allocated to these. And then sometimes I'll scour for a really good CSP entry, usually on something like AMD or Apple or Starbucks, any company that you like, Microsoft. But yeah, is there any other questions, guys? So when would you want to close a CSP or covered call? So whenever you're selling options, I normally recommend that you close out and buy them back when the credit gets cut in half, right? So let's just go to AMD. Let's say you wanted to sell like the 20 Delta, 72.5. You sell for 122. Great. You collect $122. And then to set so let's say you confirm and send, that's open. You're short the 72.5 for 122. To create your profit order, I create profit orders that take profit orders right after I sell them. You click the buy to buy it back. You change this to good till canceled so that it never cancels till it fills. And then you do your credit divided by 2. So 0.61. So I would go and change this number to 0.61. I would confirm and send, and then I'd set that in. And literally, you don't even have to look at your computer or your phone after that. Once this contract decays by 50% or so, it'll take profit for you and take your money without even looking at it. For broken wing butterflies, I do the same thing. You can see all my working orders here. They're all set to close at around $60 profit targets. So let's say I just opened this broken wing here for 35 credit. I would right click, create closing order here. It will bring up your closing order. And then you would want to, so I collected 35 cents for this. So with my broken wing butterfly strategy that I was showing, I take profit at 60. So obviously you go to 35 to 0 is 35, and then so you'd want to do 0. What's 60 minus 35? 25. So you want to set at 25 credit. So you go 5, 10, 15, 20, 25, 30, 35, 40, 45, 50, 55, 60 profit target. right? You want to close it out for $60 credit or 25 credit for a $60 profit. Set it to good till canceled, confirm and send, and you're good. Don't look at it. And then also, I see this line here. This is actually my furthest up stop loss. So that's at like the 36.38. So most of my puts that I sold, the tenths, the stop loss I use is like the tenths. It's also can be used the lowest put you bought. So like most of mine, my highest put is like 36.50. So if SPX goes anywhere under 36.50, which is about this line, you can set like the price level there, or you can create an alert at or below. You can set this to 36.50, and that way you'll get alerted. I wouldn't say like an actual stop loss because you don't know what your butterfly will be worth. Like, could even be a profit, but you can create an alert to tell you when the SPX has breached your stop loss range. It looks like I actually already had one. Cancel that one. So yeah, so now I have my line there, and if you want to draw a price level line, you just go to this little $ price level. You can click draw a line wherever your stop loss happens to be. You can do this on any stock. Say you sell an $75 put on AMD. You can go and set an alert here to alert you in case you don't check your phone very much when AMD drops below your price. So you might have to roll or expect assignment and stuff like that. Cool. So is there any other questions that you guys have for me? I think I've covered a lot of stuff today. I hope all this has helped you guys. Feel free to speak up too. You don't have to type if you want to ask me something directly. I think I'm just about out of words. Do you guys have any other questions for me? What is it? Looks like AKA might be typing here. And then yeah, I like to combine technical analysis with this. As you guys know, I don't rely on anything except for statistics when it comes to my trading strategies and the actual strategy itself, but I do, especially with CSPs, like to use some technical indicators. I like a lot Fibonacci retracements like these guys here. Draw those on like the 4-hour chart. As you can see there, you draw from high to low. And so you can see this triple bottom really well. It actually lines up with that fib line at 74. So you want to sell puts. I like the daily chart mainly. You want to sell puts at or below support levels. So that's why in AMD, you'd probably want to sell on 75 or lower. You want to agree to buy it at the lows, right? So I also use the 50 and 200 SMA lines. So you can see this purple line is my 200 SMA. I usually prefer to sell puts below this 200 SMA line, and right there at 78. If you go to like Facebook or something, it's at like 261. So I'd at least go to like, and this one's the support line's pretty close to the price. So I would look for more recent price movement. Like you can just see where prices react against, looks like if you draw a line like right here or so, like then to the left, you can see that the prices reacted against this point a lot. So I would sell puts probably that's around like 245. So anywhere under that's a good one. AKA's question is, for example, on CSP for 30 days, if within a week price drop below strike, do you get assigned, or it doesn't matter if it by expiration goes back above? So it depends. So early assignment risk. So here's the thing. When you sell a put, the person who, it depends, bought the put from you, they choose, actually anyone that's in the put can choose, but if they decide to go ahead and exercise their right to sell their shares, and the stock is it has to be in the money to do that, then you can get assigned pretty much any time. Like you got to go into this thinking that you're going to get assigned tomorrow, like that's the way it could happen. Like it's probably not likely, but it could happen. Yes. So any puts that expire or that are in the money on the expiration, if they're not exercised by the person, by the time the market closes, they'll most likely be auto exercised by the broker. But like I said, the person that is long the puts does have the option to exercise their right at any time. But most people, when they're buying puts, they're hedging their positions, and they're most likely not going to exercise them unless it goes really, really far in the money. All right. So, yeah, there's that. And you really shouldn't be afraid to get assigned. Because, again, if you do get assigned, which is going to happen less than 5% of the time, all you do, let's just say you got assigned at PayPal. Let's just say you sold puts at the top here. You sold, I don't know, $275 puts. So now you own PayPal, 100 of them at $275. All you want to do, now that you have your 100 shares, you go to any strike above 275 and you sell a call option, a covered call on your shares. And it's pretty much the same idea as selling puts, except instead of agreeing to buy your shares at the strike, you're agreeing to sell your shares at the strike. So as long as you agree to sell your shares at a strike price higher than what you own them at, then you're going to make money regardless. Again, the only downside with these is if the stock keeps continually going down, you're going to have to hold it. But luckily, hopefully you'll still be able to sell call options. If the stock falls too much, sometimes, like if, I don't know, maybe you owned it at like 380 here, like it's not really worth it to sell the call, so you're kind of stuck bag holding. So again, another reason why I like to trade broken wing butterflies with a set stop loss instead of getting, playing the wheel. But I'm not dogging the wheel at all. The wheel is amazing. I love it. It's a great strategy. Even the HaiKhuu strangle. HaiKhuu strangle is basically you sell a put, and there's a couple of different ways you can get into it. Like if you're just assigned 100 shares from selling a put, then you can go in and sell another put below your the price that you own them at and sell a call. That's called a strangle when you sell a put and a call. When you own the 100 shares with it too, we call that the HaiKhuu strangle. Alan made that video like last year. It works really well. Does toss show you shares of covered calls that actually got called away, or do you have to keep track of how many shares you had before? Does toss show you shares that actually got called away? Well, I mean, if the shares get called away, then they won't be in your account anymore. So I'm not sure if that was the question. But yeah, you can always go into your account statement and essentially look through everything that's happened. But yeah, I mean, they'll let you know. They'll probably even send you an email or something saying that one of your options got exercised, and yeah, you'll know for sure. As far as keeping track of your cost basis, though, because if you sell $195 put, let's just say you get $100 for it, then your actual cost basis for the stock, it'll say, I believe, it depends on like the way you have it set up and per broker, but sometimes they won't calculate your actual cost basis for you, and you have to do that yourself. So theoretically, if you sell a put, 195 put for $100, then your cost basis is actually 194, including the premium. And sometimes your broker will still say 195 since that's technically what you own it at. So you're going to want to, I would recommend making a spreadsheet to keep track of all your premiums. And it's pretty much like a trading journal. It's really good to have for anybody. That way you can go back and see what works, what doesn't work, what you like, and you can keep track of your premiums. So yeah, create a spreadsheet to track them yourself is my recommendation to everybody. Any other questions, guys? All right.